Sid, welcome to Validated.
Thanks for having me. Glad to be here, Austin.
Yeah, excited to have you on. I think this is an area we've started dabbling in with a few previous episodes. We had like Michael from Galaxy on and a few other folks, but I think we've been seeing over the last year or two the story that crypto is something to offer that's not the same as traditional assets and is not the same as traditional investing, but is much closer to it than sort of the like buy Bitcoin, lock it in a vault, look at it in 5 years, or the sort of like, I found a meme coin that's going to pump 3,000% type model. So I kind of want to start off at like a bit of a high level. Like, how would you describe Maple to someone inside of crypto and someone outside of crypto?
It's a good question. So for somebody inside of crypto, I would say Maple is an institutional lender and indeed kind of an on-chain asset manager, where our focus is doing loans which are over collateralized by large cap crypto assets. So Bitcoin, ETH, Sol, XRP, and so we are a lender in that sense. To somebody outside of crypto, I would liken us to an Apollo or an Ares. So these are large alternative asset managers with a focus on lending. Apollo has many different credit lines, and they even have an insurance product. But I would say we are similar to that. We fall into the alternative lending sector, and it's really a form of private credit is what we do. We just happen to tokenize it. We make all of our loans using stablecoins, and instead of taking real estate as security to protect our downside, we take digital assets. So that's typically how I describe it to people who aren't in crypto.
Yeah, so there's a lot there I want to get into, including like what on earth is going on with private credit right now. But I think sort of to start, it's very possible to look at this and say, ooh, this sounds very familiar to Celsius, which very famously blew up through a combination of bad management and over-leveraged products and a market downturn. Yeah. So I think this category triggers a bunch of people. So walk me through a little bit of like your understanding of like what happened with Celsius and why what you guys are doing is different or has a different risk structure than what they ended up getting into. Yeah.
There's a few points around differentiating what Maple does from Celsius, and they kind of vary in how technical or into the weeds you want to get. But let's say if we zoom out and go, Celsius's core business was doing lending and offering a savings product. Now, under the hood, there was a lot of complexity there, and that's where they got into trouble. So initially, their business was over-collateralized lending, and then they pay you a yield on your stablecoins or your digital assets, which is generated from the over-collateralized lending. Over time, the problem they ran into was they got too big too quickly, and so it meant that they were forced to go out the risk curve in terms of how they generated yield. So over time, it went from purely over-collateralized lending, which is actually can be relatively safe. To they were doing under-collateralized and uncollateralized lending to players. They were also doing trading and yield strategies. They were doing DeFi yield farming, where they encountered one of their issues was Badger DAO, so they got caught in a hack there. I think it was a loss of 50 to 100 million. And then in terms of asset liability matching, they got into trouble because they started taking swing trades. So they would have a bunch of folks who deposited ETH or BTC, and they would take it and trade it into ETH or trade ETH into BTC, and then the price would move the wrong way for them. So overall, instead of just running a pure play lending business, they ended up kind of running a multi-strategy hedge fund encompassing DeFi, trading, speculative positions, as well as over and under collateralized lending. So I think the essence of how you manage the risk there is keeping the business narrow. So we really just focus on the over collateralized lending. And also the other thing that we do is we, in terms of managing risk, we've set up different SPVs. So in their instance, it was one kind of omnibus entity that was doing everything. And so you had commingled risks, whereas Maple will set up different strategies that are segregated from each other, so they're not commingled. And so in that way, you just get what you pay for. You get exactly what's on the tin. We're doing over collateralized loans against Bitcoin, or this strategy is doing it against Solana or other more volatile assets. So I think that transparency is a very key differentiator.
Yeah, because I guess there's a lot of different ways to think about it, but one of them is there's a natural drive towards vertical integration in any financial product space.
100%.
And so at some point, how do you survive the risks of vertically integrating your products, or the counterpoint risk of okay, this SPV, we broke the buck on it. Are we really going to just wind this thing down? Or are we going to do some risk transfer from some other things to backstop the SPV? And then you get in usually what happens in these situations is people enter with the best of intentions and the best of risk models, and either pride or hubris or something gets in the way where they say we could let this let's just say your Bitcoin lend breaks the bank, and that's something that's going to blow up through an SPV. There's very strong incentives to find ways to lend that SPV money to bolster it back up. So how do you guys think about sort of the human management side? Because historically, this is where crypto has fallen down. Is you look at Apollo, you look at these other asset managers that are doing this stuff in the traditional world, and either they've hit a certain size or they've got a certain amount of whatever going on that they seem to blow up a lot less than stuff in the crypto space. Yeah.
Or where in their instance, often where they do blow up, it is just segregated to a single vehicle.
Yes.
Apollo had there's a great book on kind of the Caesars case.
Yep.
There's other funds where they'll gate people, but I think that balkanization of risk is really important for longevity, right? They don't allow the mothership to kind of go down, but I do get what you're saying, which is how do you protect against the desire or the seeming shortcut to kind of borrow from Peter to pay Paul if something starts to go wrong.
Exactly. And I guess it's why do you think that crypto has historically been incapable of doing that?
It's a good question. Kind of goes to the nature of human nature and greed.
Or the other way to think of it is what has TradFi done correctly that these things tend to be more insulated?
It's a good question. I think the overall you do still see it in TradFi, so I'm not going to let TradFi off the hook on that. But I would say the products are more mature. They've been around for decades, and so the governance processes are a little bit more established. I think the way to push it forwards in crypto is transparency. And so I think one of the notable differences from kind of prior cycles to 2022 was a lot of those businesses that did end up blowing up were kind of black boxes. You didn't see positions, you didn't see equity levels. There was no kind of risk reporting. Whereas, let's say in banking, as a counterexample, you have your Basel reporting every quarter or every half year, where you have to kind of show that you're adequately capitalized and you have the right liquidity levels. So I think the opacity was kind of a big driver. And I think as well, just the rate of change and evolution in crypto meant that new risks were coming up that kind of had to be dealt with on the fly, if that makes sense, not excusing the behavior, but I think they were kind of the risk management practices hadn't really had time to kind of mature and develop in a way that was actually effective, and in a way that the LPs or the people giving them capital kind of understood or could monitor. I think having more either third-party verifiers or auditors or the use of escrow agents and custodians, I think is helping to promote better risk management. But it is always a tendency that's going to be there. To kind of obfuscate things or take more risks. So it's just kind of, it comes down to how do you kind of manage a company for the long term rather than and be here for a long time rather than a good time and a short time.
Yeah, I guess so. You guys work with you've got about $4.5 billion right now through Maple,
roughly. Yeah. So we have $4.5 billion, and that's comprised of we have about, call it a bit under 2 of loans plus cash, and then the remainder is the collateral that our borrowers post us, which is the Bitcoin, the ETH, the Solana, the XRP, and large caps.
Yeah. So there's two things I really want to get into here. One is kind of around like you have a lot of these like very well-known big name companies in crypto working with you. Like what do they go for you guys for versus what they can do internally? Because I think people will be surprised to see like, oh, like Anchorage and Galaxy and Coinbase, like these are groups you would expect have a certain amount of expertise in-house. Like what's so attractive to them about working with you guys? And I guess the second piece is when you look at like, I'm very curious on the risk engine side, because you look at Bitcoin and over a 14-month time horizon, it's been at $54,000 and it's been at, whatever, almost $125,000. Like when you're looking $126,000, when you're looking at that, and that was only 30 days ago. And so when you're looking at that type of like cyclical nature and that amount of volatility, even on like the most blue chip of blue chip things out there of Bitcoin, I mean, me being a non-sophisticated actor here, I would say like, oh, okay, like the maximum I would feel comfortable lending is like a 20% LTV ratio. And that number is not particularly useful, I'm assuming, when you're talking about assets that have native yield on them. How do you guys even think about like how you adjust for risk in the loan sizes and the collateralization rates when you're talking about assets that are this volatile?
Mm-hmm. It's a good question. I can start with the risk management question first. So the market today, the average Bitcoin backed loan is going to be around a 70% LTV. So it's a very very different to kind of the 20% you were quoting.
Right.
When you see new institutions come in from traditional finance, they're looking at a 50% LTV on Bitcoin, and they're not really making inroads into the market because nobody's taking them up on that, because it turns out they're actually quite expensive at a 50% LTV. And so instead we are still largely kind of winning that business. But how do you get comfortable managing the risk? So a couple of things, the margin calls are dynamic. So if I give you a loan, Austin, at a 70% LTV, so roughly I'm giving you $1 million and you're giving me about 1.5 million of Bitcoin. I then set a trigger level at 80% LTV. So when the Bitcoin drops, I'm asking you to either give me more Bitcoin or start to pay down your loan. And I give you 24 hours. Typically it's 12 to 24 hours to do that. But I have a second trigger level where I say, okay, if Bitcoin keeps dropping during that time to 85, I'm just selling your Bitcoin. Because at that point, I'm starting to get worried that it will head towards an impairment level.
Right.
And at that point, I'm just taking it and selling it. So that's how we protect the risk. It's not that I give you a loan at 70% LTV and I just have to observe whatever happens. And at maturity, you either give me back the loan or not. That's problematic. The thing that's why, go ahead.
The thing that I find so interesting, though, is like, it is quite possible that Bitcoin drops 30% in 24 hours or 12 hours. Like we've seen these moments before. I mean, I'd be really curious to hear how you guys handled the flash crash of just like a month ago. Like what did that look like internally when we saw a ton of these assets drop by huge percentages in a matter of 30 minutes?
That's a good question. We don't really see Bitcoin drop quite to the 30% level over 24 hours, and indeed the effect of that is that it's starting to compress pricing on these types of products. So before you were getting paid a lot more to bear that volatility, but so 10/10 flash crash, we had 9 margin calls. All of our clients posted margin within 3 hours, and so this is one of the benefits of serving more of an institutional client. Retail will often selectively default on those loans, as in they just say, okay, well, liquidate me. And the reason for that is that they often can get better tax treatment for collateral being liquidated than voluntarily selling it and wearing taxable gains. So institutions will almost always post. In our history, we've had one partial liquidation where we had to sell some of somebody's Bitcoin, and that was back in the yen carry unwind in August of last year.
Yeah,
So
okay.
by and large, everybody posts because there's significant career risk if you're a PM and you take out a loan from us and you get liquidated. That being said, one of the reasons institutions will come to us is that we do more of a soft touch liquidation. So if you compare to DeFi, if you get liquidated in DeFi, it's 100% of your collateral is sold, and you'll typically wear something like a 5% penalty rate. So they sold 100% of your assets at a low price, and then they charge you a 5% fee on that.
Right.
Whereas we will just liquidate you back to your initial LTV, and then we don't charge a fee on it. So it's much more kind of institutional friendly, less career risk for the institution. But we have increasingly started using AI to back test and model out, okay, over the last 36 months, let's say, how many at these settings, what's the probability that we would have had to, and this loan duration, what's the probability we would have had to margin call that loan? What's the probability we would have had to liquidate that asset? And we've started doing that now for other assets that we might consider underwriting as collateral. And that tool has been super useful, saves a boatload of time for our originations team. And over time, you can see that's going to get more sophisticated to the point where it can just approve loans or set terms dynamically.
That's super interesting.
And that's we use that modeling now as we go and talk to traditional players, whether they be commercial banks or private credit firms who are starting to look at either entering the space or partnering with us. They obviously have very strict due diligence requirements, and so they really want to see all that kind of modeling done out in depth.
Yeah. So I want to kind of pivot a bit to like how growth has gone for Maple over the last like several years, because you guys initially started out supporting Ethereum.
Yeah.
And then added support for Solana into that. How do you think about like so fundamentally like what you're doing feels very like network agnostic at its core. But like this is a very kind of tribal space in a way that the traditional I don't think you find like traditional asset managers that are sort of like, I'll only initiate loans on NASDAQ. I won't touch anything on NYSE. So how do you think about navigating that world where you're asked to sort of pick a little bit more alignment? Like, does that roll up to the asset manager level, or is that mostly something you see on almost more of like the retail side? Because you have a token now too, which is the other component of this. It's a very interesting thing because your core product, I'm assuming, is fairly high loan values. Someone's not coming to Maple and taking out $100 loan.
No. Our minimum loan size is $10 million. So we do anywhere from like 10 million to 200 million.
Yep.
So it's an interesting question. We have so we started out on Ethereum, and then this year we actually had a foray to Solana back in 2022.
Yes.
And then our business contracted through 2023, but we went back to Solana this year, and we've now got it's about 215 million on there of kind of yield bearing assets, and then we've got Plasma, and then we've got Arbitrum, but it is interesting, as you said. I think the tribal aspect might have happened in NASDAQ if people could have been early investors in NASDAQ, and then they might have been more, picky about where they trade. But as it is, it's not like that in TradFi in the same way.
Right, because NASDAQ was launched as a nonprofit. Am I remembering that correctly, or a co-op?
Yeah, it might have been. I know CME was. Mastercard kind of started out that way, and but anyway, so I think the way that we've looked at it is, whilst our lending can be chain agnostic, there's certain clientele or communities who have a preference for a different chain. And the way that we've thought about it is, I think about it almost as kind of market geographies, and I don't want us to miss significant and growing geographies. And that's how I think about the different chains out there. And I think Solana has a terrific level of stablecoins on there. And then it's also got its own very vibrant developer ecosystem, which leans in more to things like trading And the way I've heard Solana described is it's like the equity capital market, and Ethereum was like the debt capital market. And so we've tried to ensure that we have representation there, and also tried to lean in to the strengths of of the Solana community. And so one of the things we've been looking at is, could we get Syrup USDC added as perps collateral on some of the some of the perps dexes there, whether it be Drift or it's Bullet. We already have it there available for looping on Camino and Jupiter. And so I think one of the reasons we had a more successful launch on Solana compared to some other folks who have attempted it was, I think we went in with a partnership mindset. So we went in, and instead of just trying to launch Syrup USDC there, we said, okay, we need it to be available for looping on these preferred venues, Jupiter, Camino, Drift. And so we tried to go in with a partnership first mindset. And I think that made a world of difference.
Yeah. How do you, most folks coming from a more traditional background here, or doing exactly what you're doing, service like extremely large dollar value transactions, they're very focused on vertical integration. Mm-hmm. In a way that closely resembles the way that the TradFi stack has been built, which is like, Chase is not going to give you a loan if all of your money is parked at Bank of America, right? Like, it's a very sort of different component. The way you just talked about this is very different, though, that you actually want these types of integrations. I think this kind of tails back nicely to what I was talking about before with Celsius, which is like, that is a very vertically integrated business. Yeah. At the same time, I hear more and more VCs talking about how vertical integration is like an important component of how they think about investment theses over the long term. So how do you think about balancing those kind of three components, the not blowing up by getting too vertically integrated or too integrated, the growth strategy that being open can provide, but the revenue trade-off that comes with it, and then sort of the realities now of having a publicly listed token?
One of the distinctions I draw with Celsius is I do think that they became very vertically integrated, but I think their actual issue was they went horizontally too wide. They said, okay, now we're going to do trading, we're going to do their own chain. And so one of the things I'm always mindful of is I actually don't want us to go horizontally too wide in the product set. And so I think you actually have to have an acceptance that you're in a cyclical industry, and there will be times when business experiences a downturn, and you just have to wear it. Like, stick to what you're competent at. Don't then reach for riskier products to avoid the reality of the business cycle. So I've been in lending for a number of years. And so the way that lenders fail is almost always they blow up on credit risk, right? So you have to first and foremost take care of that side of the business to be here for the next cycle. Vertical integration. So I would say I'm generally a proponent of vertical integration to an extent, because I think if you look, there was 10 years ago, there was this big craze of you wanted to be like a platform business. You want to be Airbnb, you want to be Uber, you want it to be asset light and just take a vig on all the business that kind of goes through, passes through your platform. I think that ended up being a really thin, tough to defend moat, because it kind of entirely depended on network effects. And also it's super expensive to get started and achieve that, right? Uber cumulatively lost $39 billion before they started making any profits. So that's like, that's a lot. That's a long payback period.
And they still don't really make that much profit.
Yeah. So whereas if you go the Apple, the SpaceX, the Tesla route, and you start to vertically integrate, you have more protected pricing power, and your balance sheet actually can become a moat. But the way that, so I think generally we like vertical integration, but you have to recognize the edge of your competence. And also, I think in financial services, it's not a growing pie anymore, right? So the more mature the pie and the less the pie is growing, the more it's a zero-sum game where you have to be very vertically integrated and protective, like a JP Morgan versus a B of A. However, in our space, Austin, the pie is still growing massively. And so we can afford to actually leave some value on the table for partners. And also it allows us to actually capture the growth faster and get to market quicker. So anyway, that's why I think partnerships have been worthwhile here.
How long do you think, like in your model of the world, like TradFi has gotten to the point where like the pie is growing. It's not growing that quickly. It's mostly competition between firms.
Yeah.
Consumers benefit from competition, right? Competition's good. But like, I think it's fair to say at this point, TradFi is not in that space anymore, where you can take a win-win mentality and grow the pie and like expect to outperform your competition. I agree with you, crypto is still in that. Do you have a sense though of like, are we a few years away from that ending? Are we 20 years away from that ending? Like, what's kind of your thesis on that as you think about growing and scaling out the company?
Yeah, good question. So in TradFi, where their revenues are coming from and where the revenue growth is coming from at the moment is both intra-sector competition, so JP Morgan versus Bank of America, so competing against their peers. It's also coming from regulatory capture. If you look, financial services used to be like a low single-digit percentage of GDP. Now it's gotten close to 10%, and that's just because they're kind of they're taking value from consumers by having regulatory capture, which prevents competition. So in the DeFi and on-chain sector, we're growing at the moment. We're actually growing at the expense. So there's both growth in the overall pie, like call it financial services, because it's a global product. However, you got to accept the reality that actually part of our growth is coming from eating traditional finance. So their share of GDP is going to go down, and our share, the on-chain managers, is going to go up. And so partly our pie growth comes at the expense of theirs shrinking. So I'm not kind of blind to that. But I think if you look at how long does that cycle take to play out, I actually think a lot of folks might say it's like 3 to 5 years. I think it's 20 plus years.
Interesting.
And the reason I say that is look at cards. So, first credit cards kind of effectively like mail dropped to people in like the early 80s. And then, you have like Capital One, sort of more recent entrant into that space, but that's multi-decade competition. Yeah. And then you look at e-commerce. Amazon started in the mid-90s, and then it's only after 2010 that it was kind of taken seriously as a competitor by Walmart, who initially was using Amazon for its online fulfillment, and now they're kind of neck and neck, but still very close competition, right? Like, Walmart is still a very strong business, but that's 30 years now that we're looking at. So I think crypto could be a bit quicker, but I still think you have to allow like 20 years before, because it's a generational thing as well. So Gen X is going to have a tough time moving off of banking and entirely on chain, whereas millennials and Zoomers are more likely to kind of just abandon traditional banking and financial services.
Yeah, it's interesting. This was 2021, and I was like, okay, I'm ready to like go bankless. Yeah. And there was no way to do it.
Very tough. I shifted from Australia to America, and I tell you, it's pretty hard to pay for stuff.
It's super. I mean, it's really, and this is a little different than little off topic, a little different than what you guys like do and talk about. But like, it's very interesting that like everyone still has this thesis that we're gonna go bankless, and like, as you're saying, like it's very hard for Gen X to get off banking. It's very hard for me to get off banking. Like I have a national grid gas bill that I can only pay with ACH. And like there aren't even translation services where I can like in the business side, maybe like there's Meow now, there's like Mercury's doing a little stablecoin stuff. There's the new Squads thing, but like for the most part, we are still very far away from it. Under the hood, like Meow is just Grasshopper Bank anyway. How far away do you think we actually are from a place where someone who's like a renter in a city, like nothing exotic, they're not doing crazy stuff with multiple LLCs. They're just like, hey, I got to pay my landlord every month. I got to pay an electric bill. Like, do you see us getting actually remotely close to that future?
I think the first decent product there is probably a couple of years away. But I think widespread adoption, it's like the whole Carlota Perez thing, or the timelines for technology hype, where you have early adopters, mid adopters, late adopters. And I would say the mid adopters, that's probably 5 to 7 or 7 to 10 years away. But if you look, I think, you've seen products like Stripe's bridge acquisition, Zero Hash, there's Transact. So there's a few services that do these on and off ramps. EtherFi has their card, like the interchange card, which you can use to spend. So I think you'll be able to spend DeFi assets.
Yep.
And then I think the other one is Coinbase had that integration with JP Morgan, right? Where you could easily send money from your JP Morgan account to Coinbase and vice versa. And I think you'll be able to, it won't be
but
long
all
before
that's still
kind of
banking rails, right? At the end of the day?
So yeah, entirely non-banking. In that case, I think you're looking at more like 7 to 10 plots.
Yeah.
Okay. I try and do it as little as possible. We have law firms who, we ask them to accept payment in USDC, and they're still a ways away from that. And that's the crypto practice of a law firm. All their money comes from the crypto industry, and they still don't want to take stable coins. So I'd say we're a good 7 to 10 years away from it.
Yeah. It is really interesting that the more international of a service provider you engage with, the more willing they are to take stable coins. Our law firm in the Cayman will gladly accept stable coins in a way that folks in the US maybe are not quite as willing to, or when we do a merch order from overseas, that's being manufactured in Vietnam or something, they're like, oh yeah, USDT, no problem.
Cross-border is going to be much quicker on stablecoins. I've spoken to probably a dozen cross-border payments businesses, who have been at various stages of looking for finance for the remittances, and that sector has kind of charged ahead on stablecoins because it's so much cheaper. It's kind of it's the easiest way to compete with firms like Western Union is just to use stablecoins.
Right.
And because I'm Australian and based in the US, I still have to send payments back and forth all the time, and I use stablecoins for it. It's there's no comparison between how painful the banking FX is.
So you said something interesting, which was domestic didn't feel like it was as pressing. This is kind of a classic one where I hear this a lot, and I think as I look at the value chain of why this is, it's that there's no consumer incentive to use stable coins, and the merchants are, as best I can tell, they're worried that the adoption of stable coins will decrease the percent-based fee that they can charge, even though it would technically be in their advantage. So the interchange rate on a card is 1.5 to 1.8% now, plus the overall credit card fee that's added on top of that's your 2.5 or something. But this has always been the interesting thing, and this is also a thing with TradFi is everyone's 24/7 stock trading would be so much better for tokenized stocks, and you're the T+1 settlement is basically 24 hours of a free loan of stock in TradFi. And there is this kind of interesting thing of a business doesn't necessarily want to get paid instantly because then they can't do factoring. And there's all these pieces you get into them where all these things that we think of as being bugs are actually maybe features. And I'm just I'm curious if you run into those same types of things in Maple, where you're hey, there's this whole thesis we had about why this type of adoption might be useful, but in reality, this thing we thought of as a bug in the system is actually a feature.
Well, it depends whose perspective you look at it from, Austin. So a business who sells you stuff doesn't actually want to delay you paying them. They want to delay them paying their suppliers.
Right.
So they would much rather not factor your invoice to them because they got to take a discount on it. So that's their cost of funds. And Dell famously has this awesome business because he takes payment up front and pays his suppliers 30 days later. So he's got negative cash flow cycle, or negative working capital. But I think in trading, the kind of the T+1 type settlement can be an advantage for margining and balancing the books for market makers and liquidity providers. But I think stablecoin adoption is actually partly going to be driven by vendors and merchants because they don't want to wait. They actually have to wait T+3 days for settlement, usually if it's like a credit card or something. So, and then if you look, a lot of these retail businesses, they actually make very thin margins as is. So getting back an additional 3% that they don't have to pay is pretty meaningful to their net profit. So I think that's actually pushing forward stablecoin adoption. And I remember one of the industry comments that came in support of the Genius Act was, I think it was KFC franchisees or something, who were saying how they liked the idea of instant settlement, not paying merchant fees, and reducing their working capital needs by being able to take payment up front. So I think that bottom up drive will actually push forward stablecoin adoption.
It's funny. I always the thing I keep coming back to here is are we actually going to get lower fee transactions at the end of this, or are we just going to knock 2 points off the borrow rate and everyone's just going to are we basically deconstructing the Caesar salad of a credit card into stable coins plus short-term loans in the retail space, right? That are we effectively going to say hey, you used to have a credit card, which is a bundled product of a line of credit and interest rate and a payment platform, and now instead I'm going to buy, I'm still going to was it Klarna, the consumer,
the pay as you go,
exactly. Are we just going to get that with stable coins now, where instead of hitting up a credit card or a service like that for it,
buy now pay later,
buy now pay later is going to move fully on chain, and we're basically going to look at the same type of execution. It's just going to be 80% of transaction volume is buy now pay later, because you have that 2% conversion slippage basically that used to go to the credit card. And now everyone's willing to say, oh, we'll just give you a 2% discount rate on the interest. It's kind of an interesting model to look at over the long term.
When you have the technology change, it kind of disaggregates it. And then what you find is that effectively some credit was driven by the fact that you couldn't actually get money to somebody instantly. And so effectively you're kind of forced into taking the short-term credit risk on somebody. Whereas if the payment can actually happen instantly, theoretically the cost of credit should drop, because you no longer have to take, 2 or 3 day counterparty risk on somebody. So, and across trillions of dollars of value moving globally every day, that actually, that can actually add up to a lot of profit going to somebody in the system. And I think it's been kind of resting with Visa and MasterCard for probably too long, and it would be really nice to break up those or to just outcompete those monopolies. But I'm interested in the emergent behavior that happens when you can shift trillions of dollars around instantly globally. For us, the benefits of stablecoins is that I have no marginal cost serving a borrower in Japan or New York or London or Buenos Aires. For me, I can send it. It's the same cost to serve each of them. Whereas under traditional banking, I have to go set up a new branch account in Japan if I want to serve a client there. So there's a lot of friction, and ultimately, I would pass that on to them as costs. So I can now pass savings onto those clients.
Yeah. So I think actually this is a good point I want to get into, because as you said, the marginal cost per client, especially from a geographic standpoint, drops dramatically when you're using crypto rails. As I think you mentioned though, your guys' minimum loan size is still $10 million. So walk me through a little bit of why that minimum is set where it is, and what over time might allow you to reduce that.
It's a good question. So our loan size didn't always used to be 10 million.
Sure.
As we've scaled, so now, we're at about a bit under 5 billion AUM. So the amount of time that we can allocate per loan and still be, at our deployment target, which is, let's say 85% and up, we can't spend as much time per dollar of lending doing that now. So whereas before I could have allocated my guys to 10 $1 million loans. Now, if we're sitting on a ton of cash, I need them to be doing 10, 20, 50, $100 million loans over, a given hour of the day, instead of a bunch of $1 million loans. Because otherwise I can't be fully deployed or even close to fully deployed. So what will help that is automation.
Yeah, I was going to say, I would have assumed this is one of the key value propositions of crypto is maybe it's not permissionless because I'm sure you still need to KYC people, but
Yeah.
I would think that there's a lot of efficiencies that come from just using the back-end origination system as blockchain.
There is.
Yeah.
So we aggregate all of our capital. Effectively, like the things we don't have to do because we're doing this on a chain are we don't have to have a calculation agent working how much interest to pay all of our suppliers every month because it just happens automatically with smart contracts.
Yep.
I don't have to have people double or triple checking disbursements because we have like a handshake that occurs on chain between borrower and our lending pool. So the loan always goes to the right place and it's always the right amount of money. And then I don't have to have, I still have some reporting, but I don't have to have whole dedicated teams who are just reconciling spreadsheets every month.
Right.
Because we have a real-time dashboard that reads and says, well, this much interest came in, here's how it got allocated. All of our loans are on time. None of our borrowers are in trouble at the moment. So the automation potential is tremendous. You get more benefit from it as you get a larger client book. So as we were growing and we had a couple of dozen clients, less benefit because like with each client, particularly at the institutional size, they want to negotiate bespoke things. And there's just not as many repeated processes. Now that we're getting to kind of the realm of 30 to 50 borrowers and we have a number who, just ping us to take out, a relatively standard repeat loan transaction, that's where we can really start to leverage the benefits of automation. And that's where also we can use AI for the risk assessment and say, okay, well, like this is an appropriate LTV. This is not an appropriate LTV. So we're starting to see those benefits come through. And one of the proxies for this I look at is like, well, how much is our headcount needed to grow for the 10x growth that we had over the past year? And so, the loan book grew about 10 times, but we've probably added, we've maybe added 8 to 10 people kind of across the entire business. And that includes functions like marketing and things as well. So, but our core originations team has really only added like 1 to 2 people over the course of the past 12 months. So that's where I can see that we are actually getting scale benefits from doing this on chain. And ideally for us to double again, we don't need to double headcount.
How much would you imagine that the blockchain infrastructure is saving you at the moment? Like if you were doing this, your same asset classes, but you're using a custodian for all of your crypto storage, and then you're issuing stuff via like the traditional system with wire transfers. Like, what would you say that like savings factor looks like?
It's really tough to run the counterfactual, but I would say, like, if I had to place a value on the business, I'd probably say it's close to half the business. And I don't think that's being hyperbolic or exaggerating because we actually wouldn't have the opportunity to do this but for the new rails on which it happens, right? So if you look like our business benefits from stablecoins and being able to do this. If we had to send it all through wires, you can look at how hard it is to set up like a credit fund and run that type of business. They need to almost start out with $200+ million in order to be like basically viable because of all the banking and everything that needs to get set up. It takes them months just to get onboarded to open a bank account, let alone start doing business. So if we'd had to do it the traditional way, I think our business would have been worth less than half of what it is. Or put another way, we'd probably have to, our cost structure would probably be like 40% higher than what it is today.
All right. Well, Sid, if folks are interested in learning more about Maple or getting in touch with you, what's the best way for them to do that?
You can follow us. So we're on X at Maple Finance, one word. I'm there at Syrup Sid, also one word. And then our website is maple.finance. So if you're interested in reaching out, we have a contact us page, or slide into our DMs on X. I think we're very excited for the growth ahead. In my view, we're still super early. Crypto-backed lending is really only 20 to 25 billion.
Yep.
I think I'm a big believer in S-curves, and I think we haven't hit the exponential part of that growth yet.
Awesome. Well, thanks for joining us today on Validated.
Thanks for having me, Austin. It was a pleasure.